Good afternoon once again, Market Rebels, and happy Thursday, everyone. And yeah, my voice still hasn't recovered. For those of you on the Q&A know that I've been trying to shake this cold ever since RebelCon and slowly coming through with it. So I apologize for my voice not being up to par, but we should be able to get through this. But the trading tune-ups, one of the things that we like to do here is to really give traders a different perspective. Not saying that you have to trade like me or like anybody else on the team or think like us, but we just want to give you different perspectives of things that you might not have considered. And that can only help you to make better decisions. And one of my favorite topics is with stops on options. Now, a lot of people will tell you that as soon as you buy an option, that you place your stops. And that as a form of a defense, so that if the price goes against you, it's going to automatically get you out. There's just no thinking necessary. And that sounds like a good idea until you really dig a little deeper. And that's what we're going to do here today, is to dig a little deeper and see if it really makes sense to place stops on options. So to start, first of all, let's take a look at 250 trading days. This is the number of trading days in a year, roughly. And we're going to start the stock at 100, and I've given it 20% volatility. So this is just an Excel simulation. And that's one possible stock path we could have of a $100 stock at 20% volatility. We're going to do it again. There's another possible path. Notice that they both started at 100, both have 20% volatility, but they don't get exactly the same outcome. Right? Just like if you flipped a coin 250 times, you wouldn't expect to get the exact sequence of heads and tails. And that's really what's happening here. Kind of on average, they will probably be about the same, but you're going to get a lot of variation. So take a look here. This is after thousands and thousands of tries. And yes, we'll start to find that we will form a bell curve. There's kind of some invisible limits with the highs and the lows that has to do with volatility. But you can see that there's a ton of different paths. And this is really what sets up one of the problems with using stops on options. So let's take a look at a stop order. Let's say that you buy shares of ABC for 100 and you place an order to sell ABC at a stop of 95. What this is telling the broker to do is that if the stock trades at or below this stop price, that a market order is submitted. So I often call the stop price a trigger. Think of it like a line in the sand. It is not the price you're guaranteed to get. That's a big misconception when people say, oh, I'm guaranteed to get 95. It's absolutely not true. That would be a free option. That would be too good to be true. It's just a dividing line saying that if the stock trades at this level or below, that it's going to trigger a market order. So sure, on the market open, we might gap down at 80. That triggers the order. You're going to get sold at 80, not at 95. So that's part of the thing with a stop order, is it's just this arbitrary line in the sand. So let's take a look at how this might play out for shares of stock. Let's say we've got our stop here at 95, and the stock is trading up above, and then all of a sudden it trickles down and it trades at or below 95. Now, was this a good deal? Well, it depends. If the stock does this, sure, we're going to look back and feel like we're a genius. We're going to think that was the greatest thing ever, was to have placed that stop. Saved us a lot of potential losses right there. But that's not the only path. That's not the only thing that could happen. Instead, we might get this. We might dip down a little bit below 95. We feel good for a moment, but then we look back and say, gee, that was the worst thing I could have ever done. I should have just held on. See, the success of a stop order depends on the path that the stock price takes. So what we actually call this is a path-dependent tool. A stop order on shares of stock is a path-dependent tool. And that simply means that its success depends on the path that the stock takes. And of course, we don't know what that path is going to be. Just because we pick an arbitrary point of 95 and we get triggered out doesn't mean it's going to be a good decision. It feels like it at that moment, but the movie's not over. Is it really the best decision? So let's see how buying a put might alter this. All right, so what if you had, instead of placing this 95 stop order, you had purchased the 95 put? Well, take a look now. Let's say that the stock does this wild path here, crossing 95 lots and lots of times. This is now our strike. So right here, if the stock crosses this strike, did we sell our shares? No, that's up to us to exercise the put. We still have it. And if the stock comes all the way down here, even down to zero, fine. We can always exercise at expiration and collect 95. But it's not going to trigger us out. What if the stock, comes back up here and crosses over here? Still not going to trigger us out. We still own the shares. What if the stock crosses over here? Doesn't matter. We still own the shares. The only thing that matters to us is the expiration date. So when it comes to options, the success depends on whether the option is alive. It depends on time. So we call an option a time-dependent tool. Its success depends on whether it's alive. It depends on time, but it does not depend on the path that the stock takes. So you have to realize that there is value in waiting. Very big value. People overlook that. That's the reason that you pay the extrinsic value, is so that we can wait and see how the cards have unfolded. Just because they're not favorable right now doesn't mean they won't be next week or next month. But we get to wait and see. So one reason for paying option premiums is for the right to decide at expiration. Go ahead and ride it all the way to expiration. But placing stops on options destroys one of the very benefits you're paying for. So there's always an advantage in waiting to see what happens, because there are so many possible stock paths. All right, so let's take a look at it maybe graphically. Let's say that here's today, and here's expiration. Pick a date, doesn't matter. I'm just going to say it's 30 days from now. Well, if we think that we're willing to pay $5 because something is going to happen in the next 30 days, whether it's a rally or some type of a buyout announcement or a Fed announcement, something big is going to happen. We buy this call option or we buy this put option, whatever, but we're buying a block of time. Now think about it. Does it really make sense if we feel that something is going to happen in this window of time, that we want to just place an arbitrary stop and say, you know what, I want to get out here, or I want to get out here, or I want to get out here? Because if that were true, instead of buying the 30-day option, we should have bought the 15-day option, or we should have bought the 7-day option. But see, then option traders always go right back into the same dilemma. Well, if I buy a 15-day option, I need to get stopped out after 7 days. Well, that's kind of saying that you only wanted a 7-day option. Okay, well, I'll buy a 7-day option, but then I'm going to get stopped out after 3 days. At some point, you have to take the risk. You have to pay for an amount of time that you're looking for. Now, here's also where people get tripped up, because they look at things in percentages. And they might say, okay, we know that the option is going to be trading for $4.30 after 25% of the time, $3.50 after half of the time, and $2.50 after 75% of the time has passed. So yeah, you could look and say, hey, I'm down 14% when 25% of the time has passed. Well, no kidding. We knew that the very moment you bought the option for $5. There's no mystery there. That shouldn't warrant saying I need to get triggered out because I'm down 14% and that somehow that's going to protect me. We already knew that. We already knew that when the halfway point is reached, that you're going to be down about 30%. That's just part of the square root pricing rule that we've talked about with options pricing. That is 100% known up front. Why do we want to feel like we have to get stopped out? Or when 50% of the option price remains, we've got 75% of the time that has eroded. 25% remains. And so we're going to lose 50%. Well, okay, but those are just kind of artifacts. We know that. The bigger picture is we were trying to ride from point A to point B for a block of time. And yet traders don't do this. They just say, okay, I want this block of time, but then I'm going to cut myself short by sometimes a lot just because I'm trying to reduce the losses. But those are all values that we knew were going to occur. So again, you have to really think about your reasons for putting in these stops. Okay, stops on options turn a time-dependent tool, an option, into a path-dependent tool. This is the real technical reason why I don't like using stops on options. That's not saying that you would never, ever do it, but I'm saying as a general rule, this is why I don't do it. Stops destroy the time-dependent benefit. That's what you're paying for. Okay, so stop orders aren't necessarily bad, but again, you just have to consider your reason for using them. Be sure they're not conflicting with your goals. And if you want a block of time, make sure that you're giving yourself that block of time for something to happen. A lot of times traders have very good insights into whether there's going to be a rally or whatever, but they just don't allow it to unfold because they're too busy placing stops. So that's what I wanted to talk about today, give you some things to think about. Now, a little puzzle for tomorrow. Little clue. I'm going to borrow this. This is a famous economics puzzle. It was originally done with apples. I'm going to turn it into oranges, being from Florida. But let's say that we have orange growers that pick oranges, and we have two basic camps, high quality and low quality. And the economics puzzle, the question I want you to think about, if we're going to ship out oranges, maybe from Florida to Canada or to Louisiana or Georgia, should we ship the high quality oranges out or should we ship the low quality oranges out? Interesting question. People don't think that economists think about stuff like this. They think it's all interest rates and unemployment, and it's not. It's things that are just social problems, and there's a very good mathematical reason for choosing one over the other. We're going to look at that tomorrow, and I'm going to show you what it has to do with options trading. So I want you to think about that between now and tomorrow, and we'll look for you tomorrow at 4 p.m. Eastern Time. And until then, please consider a 30-minute one-on-one consultation with one of our world-class coaches for anybody who's looking for more insights into helping you make better decisions. And the phone number there is 888-809-8058, and we'll look for you tomorrow. We'll see you then.